Yo, what's up guys, and welcome to another YouTube video. In this YouTube video, I'm going to be breaking down this exact secret system that generated me over $3 million in profits, and here's exactly how you can do it too. But before we dive into this, I want you to ask yourself, what strategy or system are you trading and how well do you understand it? Now, the reason why I'm asking this is because 90% of traders, yes, 90% of traders use a system that doesn't even make sense to them. They are purely trading a system that they saw online that works for another trader. Now, I'm not saying the strategies promoted online are complete BS, all right? I've seen strategies that do work. But what I am saying is that if you don't fully understand how the system works mechanically for various reasons, then it probably isn't the system for you, all right? Now let's dive into my CCC strategy called the Crown Club concept, all right? Now with my strategy, I use 7 key variables. I use trend lines, major support and resistance zones, previous week and day ranges, fib levels, Japanese candlesticks, chart patterns, and FVGs known as fair value gaps, all right? So these 7 variables, I combine them all together into my chart just to make sure that I understand what exactly is happening to the chart, right? With these 7 variables that I've backtested for the past 5 years, I've been able to fully understand what is happening in the chart. I can predict and react to the price movement and there look for proper A+ setup trades. All right, so let's dive into the charts and go over these 7 variables. All right, so over here we have the S&P 500 on the 15-minute time frame. All right, I'll be using the S&P 500 for showcasing the CCC strategy. Now, before you start throwing any form of technical analysis, I want you to actually understand what are you trading, all right? What exactly are you trading? Now, I see this time and time again with traders that they'll trade a pair that they don't even know what it's made up of, all right? We see this commonly with the NASDAQ, Dow Jones, and even the S&P 500. Now, one way to curve this is head over to this website called Slick Charts, all right? Now, with Slick Charts, you can see the exact companies that are listed under the S&P 500, NASDAQ, as well as the Dow Jones. Now, for this example, we will be looking at the S&P 500, all right? The S&P 500 is made up of 500 companies. To be exact, it is actually 503, okay? 503 companies. Now, when looking at the S&P 500, you don't need to know all 500 companies. It's completely irrelevant to understand or know the 503 companies listed under the pair, right? Now, why is this? It's because each company has a specific weight to the S&P 500. So what I would do is probably focus on the first 10 or 15. All right, the first 10 or 15 companies listed under the S&P 500. Now, why I say that is because from 1 to 15, the weight of the company is going in descending order. So over here, we can see the first company, which holds majority of the weight of the S&P 500 at about 6.64% is Microsoft. All right. Second is NVIDIA at 6.59%. And third, Apple at 5.46%. Like I said, focus on the first 1 to 10 or 1 to 15 companies. And the reason why you have to focus on these companies is because if something fundamentally happens to the Microsoft company, you know that Microsoft has a weight of 6.64% on the S&P 500. So whatever happens to Microsoft will affect the S&P 500 by the weight of 6.64%, okay? Now, this is quite crucial because with my system, I use a combination of my technical analysis, the 7 variables that I spoke about, but as well as taking attention into what's happening fundamentally as well as company performance. And I urge you to do the same because if you are just trading purely of what you are seeing technically, you are going to be missing out on so many trades. And you might hit a stop loss, you might hit a TP, and you won't even know the reason why you're hitting your stop losses or your take profits. Now, there's this one saying that I like to say with the system: make it make sense, all right? If it doesn't make sense, it's not valid. If you understand and it makes sense, it's valid. So this whole concept goes based off that saying, make it make sense, all right? So now we know what exactly the S&P 500 is made up of. 503 companies, but the most relevant ones, 1 to 15, all right? 1 to 15. Now, let's look at the S&P 500 here. Right now, we have the S&P 500 on the 15-minute time frame, okay? Before you commit to any pair that you want to commit to, you have to look at it from a macro perspective. Now, when I say a macro perspective, you need to see what the environment of that pair is and what it's been like since the beginning of time, all right? Just so that you can fully understand what environment you are trading in. Now, a proper example of this would be if you see the S&P 500 on the monthly time frame, all right? We can see that it's in an extremely bullish trend, all right? But then if we dissect it and look at it from, for example, let's just say a 1 hour time frame, right? We can see that price is in a descending trend, okay? Now, if you are just focusing on the S&P 500 on the 1 hour time frame, you are going to be misguided. All right, you are going to be misguided if you're only focusing on smaller time frames. The key is to understand what is happening on the macro time frame, so monthly, what is happening on the macro time frame, and then we dissect. All right, so let's start dissecting. Now, like I said, we focus on 7 variables, all right? The first variable is trend lines. So I like to have my major trend lines. I usually go from wick to wick, all right? And I always label them monthly trend. I always label my trend lines because remember, if you collect a trend line or even a support resistance from a higher time frame, there's been more data collected, which means that that trend or support resistance is much stronger than a trend on the 1 minute or a support resistance on the 1 minute time frame. All right. So having trends or support resistance on the larger time frames are typically a lot stronger zones. So we've identified the monthly trend. Now, from monthly, we head over to weekly. Okay, we can still see that on the weekly time frame, the S&P 500 has obviously been following this monthly trend. Okay, we can even go as far as neatening it up ever so slightly. Okay, just like that. Remember, wick to wick. Okay, now on the weekly time frame, I want you guys to develop an eye for trends. You need to try identify where can you see a trend. Now, typically what I like to do is at a low point, for example, over here, usually there would be a trend occurring, all right? Same thing with here, but obviously at this point, we do not have enough data and it would be a really, really steep weekly trend. So let's use the first one that we identified, okay? At this wick over here, which touched the monthly trend line, we've identified now a weekly trend. Okay, let's just make it neater. Weekly trend. So a weekly ascending trend. Now that we've identified a weekly trend, we move over to the daily. All right. Now I want you guys to see it as steps. All right. We are doing our trend lines first, variable number 1, and then we are moving over to variable 2, 3, 4, 5, 6, and 7. Okay. But we have to start off from the macro timeframes and slowly dissect. Now, on the daily time frame, we need to identify a trend. How has price been moving on the daily? Now, I can see at this point over here, price has descended, okay? Price has descended. So at this point over here, we have identified a daily trend. Now, the nice thing with this trend is, remember, once something breaks, it usually needs to retest prior to a continuation. So we saw on the daily, price broke out, retested over here, and continued to the upside. Now, that isn't the only trend that we see, okay? I also can see a trend from this point going up. So we have a daily trend ascending as well over here. Daily trend. Now, the key with trends is not to have an abundance of trends, because then your chart can just start looking like Picasso. There will be lines all over the place, all right? The key is to find trends that are valuable to your bias and to your setup. If the trend is irrelevant to your bias, there's no need to have it on your chart, right? There's no need to have it on your chart at all. So the reason why I'm having these particular trends on my chart is if price continues or does go down, further down, I have a potential confluence where price could bounce off, which is that trend. Same thing, if price continues to the upside, I now have one form of confluence, which would be this daily trend, to potentially take a short position, all right? So now we've done monthly, weekly, and daily. After daily, we move over to the 4-hour time frame, okay? Now, with the 4-hour time frame, we can probably have a bunch of trends popping off. But from this point, this is essentially the trends that we'll use for trade execution, okay? The monthly, weekly, and daily trends are more for buyers and then long-term confluences, where from the 4-hour, 1-hour, and 15-minute trends is more for trade execution. So just looking at this 4-hour time frame over here, we can identify a ascending trend that is pretty relevant to where price is currently at, right? So the wick to wick, 4-hour trend. Now, that is step one. Our trends are now done, all right? But when I say our trends are now done, we are done on the higher time frames. We are done with the monthly, weekly, daily, and 4-hour. But there's still more 2 time frames that we need to focus on, and that's while we are trading. Those time frames are the 1-hour and 15-minute time frame. Okay. Now, on the 4-hour time frame, what else do we look for? We look for support and resistance. Okay. Now, I want you to see support and resistance as a apartment building. Okay. You have the ground floor. On the ground floor, you have your support, and then you have your roof, your ceiling. Okay. Now, if you take the elevator up or if you take the stairs up, you are on the first floor, and the first floor is now the previous floor's ceiling, right, is the floor, and you have a ceiling now on top. So let me show you in this example, right? We have the floor, which is support, and then we also have the ceiling, all right? So the floor is support, the ceiling is resistance, okay? The moment you go up a floor, your ceiling is now the floor, hence support. And you go onto your next ceiling, floor, and so on, all right? But now, what if you go down a floor, okay? If you have your floors, ground floor, you go up, okay? Your ceiling, which is now your floor. Now, that's the ceiling. You go back to your floor. If you decide to go back downstairs to the ground floor, that top is no longer your floor. It is now your ceiling, which is resistance, all right? Now, this is the kind of analogy that I like to use with support and resistance, that support and resistance is exactly the same. It's just one is acting as the floor and the other one is acting as the ceiling. The moment the ceiling is broken, that is now the floor. The moment the floor is broken, that is now the ceiling, all right? And then if the floor is broken, it becomes resistance. And then if the resistance, hence ceiling, is broken, that becomes support, hence the floor, okay? So with support and resistance, it's always very tricky because a lot of people see support and resistance in different areas, okay? And this is where I see a lot of traders actually struggle with drawing their support and resistance zones. They'll just randomly have, you know, okay, over here, okay, over here, and so on. Now, this is not the right approach to having your support and resistance, right? With any form of technical analysis, you need to do your best to make sure that it is as accurate as possible, okay? Now, remember, if your technical analysis isn't accurate, that's going to lead to an inaccurate trade. So the more accurate you can be, the more accurate your setups are going to be. Now, with my mentorship class, we've kind of developed a way to spot support and resistance really, really easily, all right? So, for example, on the 4-hour time frame, if you are struggling to have an eye for support and resistance, I want you guys to take a horizontal line and focus on repetitions of candlesticks, okay? The repetitions of candlesticks. Now, the more repetitions we get in a specific range, the more likelihood that is support or resistance, okay? Now, let's focus on price over here, okay? We have a lot of gaps in this, but again, like I said, focus on repetition. Now, just drawing this over here, there's a lot of repetition over here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. You get the idea, okay? Once we draw that horizontal line, which is now the floor, we need our ceiling, okay? And the ceiling, again, same thing, you focus on repetition, okay? The more candle reps you can get in an area, the more likelihood that is going to be a support and resistance zone. Once you've identified your repetitions, what I like to do is I'll take my horizontal line, my rectangle block, label it as your 4-hour SNR. Now remember, we label everything. Then you remove your horizontal lines. Now that is your support and resistance block, all right? And you do that throughout the chart. You can't have an abundance of support resistance because then you essentially are just taking every single candle range, all right? The more repetitions you get on the chart, the more significant that support and resistance zone will be. Hence, the more accurate your trade will be, okay? So we focus on SNR zones on the 4-hour time frame, and then this is where it gets pretty good. We focus on the weekly and daily ranges. Now, what I like to do is I'll focus on the previous week and the previous day, all right? So what I do is I will go on the weekly time frame, identify the high, and then identify the low. Now, why do we mark the previous week's high and the previous week's low? The reason why we mark this is because we need to justify this current week's performance as opposed to the previous week, okay? So if price is trading above last week's high, we know that price is performing better than last week. If price is trading below the previous week's low, we know that price is doing worse than the previous week, okay? So once we've identified our last week high, last week low, I want you guys to take the Fibonacci tool, all right? Again, depending on what your bias is. So if your bias is short, I want you to draw your fib from the bottom, all right, of last week low to the top of last week high. If your bias is long, I want you to draw your fib in the opposite direction, from last week's high to last week's low, all right? So let's just say in this example, last week closed bearish, we have a spinning top. Let's just say our bias is bearish, all right? Our bias is bearish. So in that case, we take our Fibonacci, we take it from bottom to low. Now you can see a bunch of these lines have appeared, all right? And I will explain shortly what exactly these lines are. These orange lines in the center, I call my golden zone, all right? My golden zone. So this is essentially the 0.5 and 0.618 Fibonacci level. Basically 50% and 61.8% of last week's range, okay? Now I use this golden zone as a form of confluence because 50% in trading terms is extremely important, all right? And 0.618 is known as key reversal zones. So if price, for example, is trading above the last week golden zone, all right, we know that it's performing above the 50% mark of the previous candle, all right, which means it's good. If it's trading below the golden zone, it means it's trading below the 50% mark, which means it's performing bad, all right? Now, that's not all with our Fibonacci tool. Once we've used our Fibonacci tool, we need to also identify the 1.618. Now, why do we identify the 1.618? We identify the 1.618 because if price breaks last week's low, we need some form of traffic, okay? We need to have obstacles in front of us to determine where can we possibly get a reversal, where should our TP zones be, or if you're trading in the opposite direction, where should your stop loss be, all right? So you guys can see that slowly every single variable that we are using with this strategy, it's complementing our knowledge on what's happening with this pair, okay? So now that we've done the weekly high, weekly low, weekly golden zone, as well as 1.618, we shift over to the daily time frame. Now, same thing, exact same thing as the weekly ranges. We need to do it for the daily, and by daily I mean the previous day, all right? So we identify the previous day high, and previous day low. Okay, now without us even having a bias, okay, we can see that price is breaking above the daily high. So that means that price is performing better than yesterday. Okay, it's performing better than yesterday, and it's also re-entering this 4-hour trend, and it's retesting last week's golden zone. So just because of where price is currently at, we will draw our bias for a bullish bias. Okay, so in that case, we will draw it from the top to the bottom. Okay, now that we've identified what our fib levels are, we need to identify our daily golden zone, which is over here, as well as our 1.618 level. Okay, now same reasons as the weekly. Why do we have our 1.618 level is because if price breaks the daily high, we can see potentially where price is heading and where it could possibly reverse. Okay, now that we've done that, we've completed the third step of our 7 variables. Those are the weekly and daily ranges, as well as the Fibonacci levels. So the third and fourth steps are now complete. First would be trend lines, second support resistance, third weekly and daily ranges, fourth fib levels. All right. So now we are essentially done with the higher time frames, and we'll start playing around with the 1 hour and 15-minute time frame. Now remember what I said, okay? As we are looking for a trade setup, we are going to incorporate 1 hour trends and 15-minute trends. The reason why we do this is because when we do execute a trade, we need as many additional confluences as possible to determine what kind of trade is that. Is it a C trade? Is it A trade, or is it an A plus trade? All right. And the way we can determine that is the more confluences we have in a key area, the better the trade setup will be. Now, the only thing left would be is what is your bias? Okay, you can have all your technical analysis right, but then if your bias is incorrect, your trade obviously won't play out. Now we are on the 1 hour time frame, and I can see a 1 hour descending trend. Okay, 1 hour descending trend. Again, label your markings. Label your markings. So that's on the 1 hour, and let's move over to the 15-minute and see if we can get anything else. Okay, 15-minute, I can see a trend accumulating as well. So easy way to identify a trend, low point, like that, 15-minute trend. So just looking at what price is currently doing, again, we're making it make sense, okay? Price bounced off the daily low, the previous day low. So it didn't dip below, it didn't perform worse than the previous day, okay? Price is trading above the golden zone of yesterday, so it's performing better than yesterday, and it's past the daily high already. So what does that mean? What can that tell you? All of these confluences that we drew, okay, it's telling us the direction of that trade. So we can know that the S&P 500 is extremely bullish, and we need to be focusing on long positions. Now, because we did our trend lines, our support resistance, our weekly daily ranges, as well as fib levels, that helped us determine our bias for the day. Now, what is left? There's 3 more steps left. Fair value gaps, Japanese candlesticks, and chart patterns. Now, it's very subjective when it comes to chart patterns, because there's a vast array of patterns in the trading space. Okay, but the key is to identify ones that pop up more often in that specific pair that you trade. Okay, because remember, pairs always repeat themselves. They always follow the same systems. Okay, so just looking at the 15-minute time frame on the S&P 500, because we're bullish, we can't just randomly go along here and have a random stop loss. Okay, we can't just randomly do that. That is gambling, and this is what I see so common in the trading space nowadays. People will be looking for 1-to-2 trade setups, 1-to-1 trade setups, and their stop loss will be in a completely random zone. And this is why a lot of traders fail, because their trade bias could be completely correct, all right, but their stop loss is preventing them from actually winning a trade. Now, your stop loss needs to be in a position where if price comes into that, your bias is completely flipped, right? Because price is trading in that range now, you are no longer bullish. You are now bearish. It doesn't mean that you should take a sell trade, but your bias has flipped. And that's the only time that your stop loss should get hit, if your bias is wrong. Okay, if you are just setting up a random 10, 20, 100 point stop loss, you are bound to get tapped out and miss out on a winning trade. Now, with this kind of trade setup over here, okay, let's focus on an FEG. Now, what is an FEG? An FEG is a fair value gap. So that essentially, what that essentially means is that there's an imbalance in buyers and sellers. Now, how I can identify an FEG is based off candle momentum. If you see a strong momentum candle, bullish or bearish, typically there's an FEG. Now, what I've done is I would use my Graham box tool, okay? If price is going up and you predict or assume that there is an FEG, you would take your Graham box from the bottom to the top, and you can see that I've identified 0.5 and 0.65. So that's essentially 50% and 65%. If price touches 65% or 50%, there's no longer an FEG. That gap has been filled. That gap has been filled, and that's no longer a zone. Now, just looking at how price played over here, okay, let's just say, for example, we had this FEG marked out. 1, 2, 3, 4, 5, 6, 7, 8, 9 15-minute candles. all right, well, on roughly the upside above, and then the 10th candle came down, filled that FEG, and then continued to the upside. Why did it come down and fill? Because there was an imbalance. Now, what do we use FEGs for? Same thing. We use it for confluences. We use it as a form of entry, okay? So that would be an FEG, but that obviously got tapped out. Now, I just want you guys to see high momentum candle, okay? And it's bullish. So because it's bullish, we take our gram box from the bottom to the top. All right, that is an FEG. So because we've identified an FEG, we would like price to essentially fill that imbalance prior to continuing up. Now, in this example, okay, we could use this as an entry. But like I said in the beginning of the video, we have 7 forms of variables. We can't just enter based off one. But over here, what exactly do we have? We have the FEG, we have the last week golden zone, we have the daily high, we have the 50-day moving average slowly creeping up, okay? And that's about it. Okay, so right now, as it stands, we have 3 forms of confluence. So 3 out of the 7, and you're not always going to get 7 out of 7. You're probably most likely going to get 4 or 5. All right, so 3 is pretty decent. We have 3 reasons why we could enter in this zone: a retest on the daily high, tap at the bottom of last week GZ, and as well as fulfilling this FEG. Now, you might ask, that will be our entry, but where is our stop loss going to be, and where is our TP going to be? Okay, for me, stop losses will always vary because it needs to be in an area. Once price comes, it's no longer valid. All right, our bias is incorrect. So based off our technical analysis that we've used, we have our traffic laid up ahead. Price is trading above and within a 15-minute trend. Price has surpassed the YesGZ, and price has surpassed the daily high. So what I would do in this example is I would have my stop loss slightly below the previous day golden zone, because remember, if it dips below that 50% mark, all right, that means that price is performing not at the lowest point of the previous day, but it's underperforming than yesterday's price movement. Okay, so my stop loss would be over here. TP would be at yes 1.618. Right, now this is a 1.25 ratio trade, right, which isn't necessarily one of the best, but the nice thing about the system is everything's laid out for you. You know where to place your stop loss, you know where your entry is based off your confluences. Now, we put the at yes 1.618, right, but that doesn't necessarily mean that's the only TP range that we can get. If we move over to the 1 hour time frame, we've already done our homework, we've done our analysis, okay, and we could potentially aim for last week's high. Now that would give us a basically close to a 1-to-3 ratio, 2.5 to be exact. And this trade setup looks a lot more promising. Okay. Now, what did I say in the beginning of the video? Make it make sense. Just looking at all the technical analysis that we've put right in front of us, we have a 1 hour descending trend. Price is trading above that. We have last week's golden zone, price is trading above that. We have yesterday's golden zone, price is trading above that. So for today, I would say that the S&P 500 will flip bullish, hit the 1.618. Now, depending if we surpass that or not, we could aim for last week's high. Now, again, what I mentioned in the beginning of the video was 7 variables. We've done trend lines, support resistance, weekly and daily ranges, Fibonacci levels, fair value gaps. Now, what else is missing? Japanese candlesticks and chart patterns. And in the next video, I'll be going exactly over my secret approach to Japanese candlesticks and chart patterns, so you can have the additional 2 variables for your confluence trades. Now that's the end of the video. I hope this video was extremely valuable for you guys. And remember what I said in the beginning of the video, make it make sense. Trading has to make sense. Your system has to make sense. If you don't fully understand the mechanics of your trading system that you're currently using, you are bound to fail in this trading space. As long as you can understand what your analysis means, predict, react to what price does, you guys will be all good. Now remember, in the next video, I'll be talking about Japanese candlesticks as well as chart patterns for the last 2 variables of my CCC strategy. I do have a Discord group below where I do go live every single day to plan my trades. The link is below. If you guys want to join there, I would love to see you. Comment below what you think about this video, and I'm excited to put out more videos like this for you guys. Take care and thanks for watching.